In this section, we will clarify the definition of mortgage fraud and take a look at some potential misrepresentations. Mortgage fraud is the intentional misrepresentation, misstatement, or omission of any material fact with the intent on reliance by anyone involved in the mortgage transaction to fund, purchase, or insure a mortgage loan. Misrepresentations can include the market value of the property that is being used as the collateral for the mortgage loan is inflated by the appraiser, the amount, type, and source of the purchaser's down payment are falsified, the amount of the closing costs and the source of the funds used to finalize the transaction are erroneous, personal information about the purchaser's creditworthiness, including income, debt, credit history, and verification of employment are falsified, who will actually be living in the property and what will be the primary use of the property is not disclosed, and undisclosed rebates, credits, or monetary transfers to one of the parties, usually the purchaser, that are not reflected on the closing statements. It's important to note that mortgage fraud can take various forms and strategies, and mortgage fraud such as a straw buyer scheme, income and employment fraud, appraisal fraud, equity skimming, and silent second mortgage schemes represent only a fraction of the schemes that have been observed in the past. Mortgage fraud schemes often involve multiple parties such as borrowers, real estate professionals, appraisers, and even mortgage brokers. We'll dive into the two types of mortgage fraud in just a bit, but first let's take a few minutes to cover identity theft.